If you look at the average mortgage rate on the book, it peaked around 6.45 in October of last year. So 12 months down the line, we've had a good 125 basis points of, reductions in terms of that average loan rate through the book. That would be no different, from the other banks out there.
Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Okay, welcome back to Markets, Mystics and Mayhem, another episode. And today we've got a special guest, Belinda Newman, our treasurer, on to talk about financial markets. It's funny because the last time you were here, it was post-Liberation Day and it was all about the US. We've just had some data or some, news from the US again about their government shutdown coming to an end. So it just seems to be whenever it's something about the US, we have you coming on. But it's going to be really good to hear your insight on what's happening in financial markets. But I guess to start things off, we had a really fun event last week with our clients where we got to hear from Professor Prasanna Gai of the Reserve Bank's Monetary Policy Committee. He came. It was really good to hear just his perspective, I guess, on how the economy is tracking and, what challenges it's currently facing and how he views them. How did you guys find the event? It was a pretty good one. I mean, it shows that we can kind of pull these guys.
Yeah, no, I found the event incredibly informative, and I know, certainly speaking to the few customers that I spoke to afterwards, they found it really useful as well. Just incredibly useful to hear firsthand, I guess some of the considerations that the MPC does weigh up when thinking about monetary policy decisions and like the challenges that we're facing right now and also looking forward with Dr. Bremen, starting obviously in December, what the future holds.
Yeah, I thought it was a great event as well. He was really personable and easy to listen to. You sort of go in there going, okay, he's a professor, academic, what am I going to get? I actually got some really great insights, like you say, on how the MPC works, but also the different pressures that they face. Very difficult few years that the Reserve Bank's been through. We give them a lot of criticism, deservedly. But it's a hard process, right? And I thought it was really good to get someone like that in because it's quite different. It's quite different to normal sort of policymakers or economists or whatever to have someone like that. Yeah, I thought it was great.
Yeah, he didn't give anything away for the next November MPS.
Well, he did, but we're not telling the public.
Yeah.
No, he didn't for the record.
For the record, he didn't. But yeah, I guess it's just good to hear. He was, fun fact, he was one of my lecturers at uni, so it was good to kind of see him on the MPC. I know his background's in this stuff, so I actually took a screenshot.
There was a good question at the end.
Yeah. I had to dig up one of my old exams and kind of prod him with a question that he gave us all those years ago. And I thought it was a quite timely one. I've got it here. It was, long periods in office are crucial for the credibility of central bank governors, and it was discussed that statement. And I thought that was quite
just
timely.
After Adrian also.
Yeah, exactly.
yeah, very timely.
Very timely. But I guess it's good. I mean, it's the next one's not till next week, and we'll see what they'll say then, and to have more colour then. But it's good to hear from them between meetings, like what other central banks do.
Yeah, and for financial markets, it's a difficult one, isn't it? It's like here we are in November. They're going to make a decision. They're going to tell us something, but they don't come back until Feb, right? It's hard for traders.
Yeah, it's a very long time, between meetings, particularly over the summer break. I think, in future years, they've indicated they're obviously going to address that and not have quite such a long break as what we're having, coming up. But, certainly very interesting to hear from their perspective. Hear his perspective. I think, the key thing that came through to me just, I guess, reinforcing what they've already publicly said in terms of it, you're just getting that comfort around inflation expectations being stable and, not showing any signs of, expected pickup in inflation from, general households or businesses from here. So, that's certainly something that they kind of indicated back in the statement, and, essentially he was just reinforcing that.
Yeah.
He also, someone asked him about the neutral rate. And he said it's kind of just one of those rates that, you don't really know where it is, but you kind of know if you go far enough through it that you're on the other side of it. I thought that was an interesting comment, right? We're all sort of agonizing over, are we at the bottom? Are we at the bottom? But it's too early to tell.
Yeah, and I think that's probably, right, in particular in the New Zealand context where you don't have, you've always, because of the fixed rate environment in terms of the mortgage book, you don't have long periods where rates are steady and rates that, say, households and businesses are, steady, that those long periods really only come, 12, 24 months after the last cut or after the last hike. And so, as a consequence, it's very difficult to figure out at what point you've been, through that level where monetary policy starts to have a stimulatory or contractionary effect, I think.
Because, for the record, neutral somewhere around 3, whether it's 2.5, 3.5, it's kind of around that 3 level. We've only just gone through it in October, right? So, we hopefully will go to 225 next week, and then possibly 2, but we've only just, I think, gone through into stimulatory settings. It's definitely what I'm hearing from businesses and investors. A 7.5 mortgage rate was really high, 5.5 was kind of, and now we're getting into levels that are fun.
Yeah, absolutely. Certainly as we start to see, I guess the recent rate cuts have effect. We're seeing better signs, in terms of the economic data coming out. We're seeing credit growth maybe, that's stabilized and may well start to increase from here, certainly on the household side of things. But it has been a very, very slow recovery versus what we were expecting, even last time I appeared here 7 months ago.
So what are you seeing in credit? From the bank's perspective, are we seeing business lending pick up, or?
Yeah, I'd say it's still isolated in sectors as opposed to broad-based, absolutely. If it's a sector that's servicing the rural side of the economy, that part of the economy is obviously doing very well with record terms of trade. Obviously farmers that are looking relatively cashed up with great dairy payouts, meat prices are doing really well and the like. So, that part of the economy is doing quite well, and that's probably more evidenced in, some of the regional data that we're seeing. South Island in particular looking quite strongly. I'd say, again, as you go further north, perhaps it becomes more subject to what the regional economy is doing, like, the housing recovery in Wellington probably in particular is quite slow. Auckland, from a development pipeline perspective, has been pretty flat, but, may well start to increase from here, given the rate stimulus that we're seeing now. But still very varied, I'd say, across the business side of things. And on the household, I think generally speaking, as the rate cuts have started to play out, then again, more confidence. We've probably had, if you look at the average mortgage rate on the book, it peaked around 645 in October of last year. So 12 months down the line, we've had a good 125 basis points of, reductions in terms of that average loan rate through the book. That would be no different, from the other banks out there. They're, looking at where the current mortgage rates are, there's potentially, still some further substantial falls to come as that book continues to reprice. So, but definitely, we thought that the recovery would be at the, over summer of last year, but certainly we can be a lot more confident now heading into another summer with where rates are now.
Yeah. I was looking at the sort of non-performing loans across the book, and it was quite interesting to see agriculture was projected to go like this, and it's actually gone completely the other way. As you say, they're getting paid well, and they're paying debt back quite quickly.
Yeah, that's right. Yeah, no, agriculture's by all accounts is looking really good across all the industries. So, fantastic news from a New Zealand Inc. perspective, but, that's only one small part of the economy. Certainly starting to see that come through, though, in terms of volumes through the port, for example,
Right.
and the like. So, they're starting to spend that money elsewhere, which is a good sign.
Yeah. And that's probably the thing. They've been running down debt, but that rate relief hasn't quite hit the real economy yet because they've been doing this kind of consolidation and just paying down their debt rather than actually spending it on, other things like, more retail or anything. So we haven't quite seen that spread of, pickup in activity or anything across the rurals into the urbans, because for the urban centres, it's mostly around the housing market and how that hasn't quite picked up. Right?
Yeah, and financial services, isn't it? So, and it's interesting that, Canterbury, the farms are generally larger and they have a lot less debt. So I think we're seeing more flow into that region via the farms, whereas in the Waikato and other areas, they're smaller farms and have a bit more debt. So I think we've seen more consolidation in the North Island, a little bit more spending in the South, and that's why, the South just looks, so much better, and more optimistic than the North.
Yeah. I think in terms of the urban economy is the other thing that's obviously playing out as the government's, fiscal stance and how much that's impacting on employment, particularly in Wellington, but also perhaps to an extent from a consultancy perspective, in Auckland as well. There's a lot of factors, that are kind of driving forces, I guess, behind, some of the data that we're seeing.
Yeah. I heard one of the consultants had to shed dozens of jobs just on Three Waters and a few other things, not going ahead. It's like, wow, that's, that obviously geared up for quite a lot of work. So when it comes to market pricing, traders have factored in a full 25 basis point cut in November, and then there's a bit of a chance of another cut to 2% in February, certainly not fully priced, but there's thoughts of it. And then we tackle the big question of, well, have we found the bottom? And if we have, how long are they likely to be on hold for? And I think from an economist's perspective, we would say we would love them to be hiking by the second half of next year, because that means monetary policy's worked and the economy's rebounded. But we don't know. What are your thoughts?
I mean, I think market pricing, is always a reflection of, differing probabilities on a range of possible outcomes. Like, it's certainly not indicating one path. The thing that I'd challenge you in terms of your view is, obviously we're coming into the next election cycle, and, what is going to come from that in terms of economic stimulus potentially, or like on the flip side, what uncertainty is that going to bring about? With the last election, we obviously saw, national revoke or, essentially amend a lot of policies that Labor had introduced, and, potentially that didn't help in terms of that business confidence and, I guess doesn't create a good environment for businesses to invest in. So that's kind of one thing that I'm thinking about.
Particularly with the CGT.
Absolutely.
I think that's got a few people, capital gains tax, I think that's got a few people worried.
Yeah, for sure. Another thing that
the first step of many.
Yeah. And maybe we can discuss, but I guess in all of that, another thing that I'm thinking about currently, I guess, is the sustainability of New Zealand's debt trajectory. And, we know that we're kind of on a path to, a neutral budget. But I guess what does that mean in terms of how that then interplays with monetary policy going forward? So, if the fiscal backdrop was more stimulatory, then perhaps we would be hiking sooner. If it remains constrained, then, perhaps that means a more prolonged period where we're at, 225 or even below.
Thinking about the last budget, this Go for Growth budget, there were some good things in there, but basically if you sort of stripped it right down, there actually wasn't a lot of stimulus in there at all. There was this investment boost, which, great idea, but it's all about the appetite of the business, and the business isn't there. The business owners aren't there yet. I think that investment boost plays a part potentially next year.
Mm-hmm.
But at the moment, businesses don't have the confidence to buy the machine.
Yeah, that's right. And with the if you think about the New Zealand context and apply a similar global backdrop as well, it's not just the New Zealand government obviously in this position. You've in fact got probably other foreign governments potentially more fiscally constrained. Then that may well lead to a period, more prolonged period where policy rates are, on the lower side of what we might otherwise expect.
Yeah.
And then it's funny because when you look at history, it's really no help here because there's just you can't quite say, the cash rate kind of stays at troughs for X amount of months on average. I was looking at previous cycles and it's really quite different each time. You could say on the way up, the cash rate kind of peaks and stays at its peak for about, 12 to 18 months or so. You can't really have the same kind of rule of thumb when it comes to the other side, the cutting side of it. So it's really no help to look at history either there. It really is just how is the economy responding to what's been delivered. And for now, it seems like it's been very slow to respond to the 300 basis points of cuts. So it's a case for maybe keeping it low for a little bit longer.
Yeah. So when you say low, are you still confident in your 225 call for a low in the OCR?
Yeah, I guess we are. I think we are. But, we wouldn't be surprised if they go to 2 just to make sure the job's done.
Yeah.
I would certainly think that Anna Bremen might want to come in and just sort of put a mark on a few things. So cutting to 2 in February, I don't think it's much of an argument really. It's just about, like you say, how long are they down there for? And I think it could be quite a while.
If others on the committee felt that there was a need for the OCR to get to 2, do you think there's any credibility in them going 50 basis points in November?
In November? Good question. Yeah, I think the market was flirting with that idea a little while ago. It was like 29 basis points priced in for Nov, so just that small chance of maybe a 50. It's certainly not out of the realms of possibility. I think because the market's priced for 25, they might not want to shock that much. I don't know.
Yeah, I've just heard some indicate that potentially with Dr. Bremen coming on board, it may well mean that the November move is the last move and, possibly she starts and, perhaps her first move isn't another cut and the last cut of the cycle, but perhaps, she just starts in February and it's right in terms of her first MPC and, rates are on hold from there on.
Yeah, I guess it would make her job cleaner, wouldn't it? Come in, the rate cutting's done, and you've got a clean slate, and away you go. I don't think she's kind of sitting in a bubble somewhere. I think she's involved with the RB already. I think she's involved in a few internal things, like even though her first start date is 1st of December. I don't think there's any doubt that she would have some information. Yeah, as she should, like as a handover.
Yeah, I guess it's just what happens over the summer. It's going to be a really important time just for seeing how the economy picks up if it does. What's really interesting is that we saw a pickup over the summer last time and it clearly wasn't sustained. So what if we do see a lift in activity now, but then come the middle of the year, somehow that momentum slows down as well? Is it just kind of a seasonal lift? That's the big question. But that's a question that won't be answered before the February MPS though.
No.
So
we're such a seasonal country, aren't we, with agriculture and horticulture and all this sort of stuff that, does better over the sort of the warmer months. And then obviously we sell more properties over the warmer months. So, spring and summer give us a really good idea as to how things are going.
Jared, you in particular, I guess, really good, insightful information in terms of all of the engagement that you have with our customer base and, various other New Zealand business owners and everything through the conferences and everything that you attend. I guess, is there anything that you're hearing now that would indicate that anything more than, another 25 would be required?
No, when I speak to a lot of businesses, across the country, the feeling is one of a lot of frustration. It really is. Like we thought we were going to recover in 2025. We didn't. We're still sitting here. They get the idea that rates are now at levels that are enticing some of them, but then I'm still hearing excuses around, oh, what if Labor gets in at the next election and there's a capital gains tax? And I'm like, well, it's not the end of the property market. Let's make that clear. But they think, well, then it's going to be a wealth tax, and then it's going to be something else. There is a lot of uncertainty going in, and it really is different depending on where you are. Like if you're in Christchurch giving a presentation, or Queenstown, much more upbeat than Auckland and in Wellington. I just can't wait to get out of that place. Like, jeez.
So I guess how do we then feed all of that into our view on house prices?
Yeah, great question. I mean, the biggest driver of house prices is interest rates. So the fact that mortgage rates have gone from 7.5 into the 4s is the biggest driver of our outlook. We then talk about supply demand, and yeah. What are your thoughts on all that? Because you've basically just postponed our recovery in house prices, haven't you, in terms of our forecast?
Yeah, I guess one thing that's really kind of kept a lid on house price growth this year is well, two things. Is that the market's been really well supplied. There's been a lot of listings in the market which, interest rates are a big driver, but it kind of shows you the power of supply in a market like that. That if you really do flood it, it can really pin down those house prices in terms of growth. The other thing that's really been having an influence on the market is the slowdown in population growth.
Yeah.
How this time, what was it, 0.8? Our population's grown 0.8 in the last year. That's down from 2.5%, 3% this time last year. So that really big slowdown has obviously weighed on demand. So you have those two forces that just aren't quite conducive for price growth just yet. But as the population growth kind of stabilizes, we do expect the pickup to come. But again, it's one of those things that's just been pushed out to next year.
Yeah. And investors are on the sidelines. So they're a big part of the housing market, and they have been sidelined until very recently. So, what are we seeing on our sort of lending?
I mean, I'd certainly say the investor activity is still out there, but it's not necessarily new purchase. It's more kind of in the refinance space.
Right.
I don't know that investors are out there necessarily buying new properties and, using additional leverage, to facilitate that. I think they're just kind of on the sidelines, and, some of that is just that policy uncertainty in terms of the election cycle, and, as we just mentioned capital gains tax earlier.
Yeah.
Otherwise it's, a softer rental market with more supply having come on board. That's not just existing houses coming on the market, but also, those developments being completed and new, subdivisions coming online, then, that's obviously flowing through into lower rental yields and everything as well. So it's just kind of watch and see. It definitely feels like a space where there's a lot more equilibrium than historically there has been. So that's a great thing, for those people that don't yet own a home and for those renters. But yeah, it just might mean that we're in a period of, more stability in house prices as opposed to house price growth from here.
Yeah. Yeah. Supply is a big part. It's interesting as to where that supply is coming from. I think a lot of it was just on the sidelines for a while, and then investors have gone, okay, well, I'll test the market. I can't sell it, then I'll turn it into a rental property, and all of a sudden rents are off quite a bit. So like you say, rental yields are going down and interest rates are going down. It's like investors want those things to be close.
And certainly we still want the development pipeline coming through, but we're also hearing that, there's not as many pre-sales for developments these days. So obviously it's up to developers really to back themselves and go ahead and subdivide and build on the land that they have.
Yeah.
And, hope that the buyers obviously come. And so that, in itself creates more uncertainty.
Yeah. I mean, you can back yourself as a developer, but if you don't get the pre-sales, the bank's like, no, you're done. We're not going there.
That's right.
So you really need that market to be there.
Yeah.
And I just don't think it's there in many cases at this point.
Yeah, not yet. It is a concern though to hear that investors or businesses are kind of worried about the election next year for what that might mean a whole year out. Because usually
it's been more. It's
yeah,
been since the beginning of this year they've been talking about it.
which is a really long time. And usually you'll see this slowdown and this more precautionary behavior in the couple months, maybe quarter ahead of the election, just sitting on your hands waiting for the result. But to have a whole year out, more than a whole year, it really has quite a it has that slowdown effect on the recovery in the economy in general.
Yeah, I think it's to do with your current environment, though, right? Like we're still going through this recession, we're trying to get out of it, and then any threats to the recovery really kind of freak people out a bit.
Very weird.
Whereas if we were in a situation where the economy's growing 3-4%, unemployment's heading south, people would probably ride through the election with a bit less worry.
Yeah, that's right. Everyone's just we're coming out of an environment where everyone's been so focused on the risks and what could potentially go wrong. And, that just, an election next year just really plays into that, unfortunately. We need people to get more optimistic about, about the future and about what the economy offers ahead. So, not quite there yet.
Oh, we need some good news.
I reckon
we're getting there.
I reckon we're getting some.
It's just been so slow.
You gave us some last week in the labour market.
Oh yeah,
I think that's a big
things are turning
in the right direction.
Yeah.
And I think we'll get some good news over summer.
Yeah.
Yeah, absolutely. I mean, the fact that we can have been through what we went through over the last few years and, unemployment rate where it is, I mean, that's a really fantastic thing from our perspective. Perhaps partly reflects the fact that there's
loans.
Exactly. Yeah, that's right. Balance sheets, from a bank perspective anyway, so healthy. Perhaps in part that reflects the fact that the Australian economy's been able to lap up our surplus labour, to the extent that people might become unemployed here, then they can go and, enter a different market and hopefully get a job there. But it all means really positive things, I think, for the path forward.
Yeah, I think we need to be clear. I think Australia is we're part of their labour market, whether we like it or not. It's like a 3-hour flight. It's not hard to go over there and get a job. Like if you've lost your job here, it's not that hard to go to Australia.
And that's what we've seen as well.
Net outflows of what, 70-odd thousand?
Yeah.
It's a lot. A lot of Kiwis leaving.
Yeah. Most of them going to Australia.
Yeah. A lot of demand out of housing.
Yeah. Yeah, their economy is just in much better state. But actually, positive news, Trump has removed the reciprocal tariffs on agriculture products like beef, which is good. Meat, I know, I need
Americans love their burgers. Come on.
And, that's good news for us because that's like the number one thing that we export to the US. So.
It's funny because he indicated that was because other countries were giving up ground, right, and coming to the party in terms of negotiating. Yeah. And the reality is obviously it benefits us and Australia. Yeah. And we've not really negotiated anything up to this point, but we'll take it.
At the end of the day, there's a shortage of supply going into the US, so they just address it that way, don't they?
Yeah.
So, that's definitely some good news because it is our largest export to the United States.
Yeah.
Meat. So that's great.
Just shows the benefit of a great reputation in terms of the goods that we're selling, right? And, so we've got some attractive goods to offer and, obviously they want to be able to buy them. So it's fantastic for our sector.
Yeah, and the currency's gone down as well.
Yeah.
Which is really helpful for exporters. So not only are they getting really good payouts, they've got a currency which is working in the right direction for them as well, which was offsetting those tariffs.
Helpful for exports and really helpful for tourism too, for inbound tourism.
Yeah, and summer tourism.
Yeah.
Right, what we want. We want to be back. We're back at about 90%, aren't we, of pre-COVID tourism levels. Be great to see that back at 100 over summer.
Yeah.
That'd be cool.
You just need to spread those tourists out around the country as opposed to just having them focused on the South Island. Yeah.
We need a advertising campaign for the North Island.
Exactly.
So, at some point, we're going to find the bottom And the cash rate, we're not sure where that is, but we hope we've sort of found it by February.
Mm-hmm.
At that point, maybe we're going to get a few economists coming out saying this is the end. What do you think markets and customers and stuff do it at that point?
Oh, we've been waiting for a while to see the tenor, the duration of our mortgage book start to lock in fixed rates for longer tenors. Really a feature of kind of the last 12 to 18 months has been how short the refixing has become. Borrowers would, historically borrowers would typically, fix for 2 years as a standard tenor, but that got as short as, 6 to 12 months, probably over the last 12 months. So, we're looking at the profile of the book is very short now. I think we mentioned up to, not quite 80% refixes over the next 12 months. And, what we're likely to see, given the flatness of the mortgage curve anyway, is, borrowers look to kind of lock in that certainty now that fixed rates are kind of sub 5%. So they're ready, and if there is a period where we do start to see rates increase or funding pressures increase from a bank perspective, then, a fixed rate obviously provides the borrower some protection against that. So I think, potentially more a story for next year, and it will come in ebbs and flows, depending on, the outlook for the OCR, but certainly watching to see a portion of the fixing shift to longer tenors, probably more what we'd typically expect in the 2-year tenor, around that kind of 30, maybe 40% mark, and then, even a small portion going 3 years and 5 years.
Yeah, I do get the feeling people are just kind of sitting there waiting. Like I want to get the low in interest rates, and I feel that in business lending as well. If there's another excuse for them just to sit back for a little bit, it's they want to get the bottom in the yield curve.
Yeah, absolutely. We've certainly seen that behaviour even just leading up to OCR decisions where, there might be an expectation that, fixed rates may well end up lower after the decision. And so customers who have their rate coming off a fixed tenor might actually switch to variable for a short period of time and then refix after the OCR decision. That strategy has actually worked really well where they're delivering, surprise 50 basis point cuts because, you do actually get more carded rate cuts coming through, but obviously in a flatter OCR environment, then, there's no benefit. So
I think people just, a bit more attuned. They're a bit more on top of when these decisions are. They're obviously very interest rate sensitive. I think that's always the case, but it feels like there's this need to get that next lower rate is
Yeah, but I think that's a good sign as well. At the end of the day, financial literacy amongst the general New Zealand public is improving and has grown, substantially. It's not to say there's not more room for improvement, but, it's great that the average borrower out there understands, how important these decisions are, for financial certainty, but also like trying to obviously get the lowest rate, balancing those two things and, making good decisions with all the right information at hand.
Yeah, absolutely. I think that covers everything.
Covers it.
I think we're done for another week. Thank you very much, B, for coming on. It's great to see you again.
Yeah.
We'll get you on in the new year when we've found that bottom in the cash rate. Hopefully.
Yes. or something else will have happened.
No, we're not going down there.
No.
Well, thank you all for joining us and tuning in. Please like, subscribe, follow, share with your friends, and we will see you again next week. Thank you. We're done. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.